Okay. I'd like to welcome everybody to the County Employees Retirement System regular call meeting for March the 10th. I'd like to call this meeting to order. Eric, do you have the opening statement for us, sir?
I do. This is a regular meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Okay. Thank you. Sherry, can you take the roll for us, please?
Yes, sir. Mr. Cheatham,
Here.
Dr. Carver,
Here.
Mr. Foster,
Here.
Mr. Fulkerson,
Here.
Dr. Hackbart,
Here.
Dr. Milkman, Mr. O'Mara,
Here.
Miss Pendergrass,
Here.
and Mr. Powell.
Here.
Thank you.
Thank you, Sherry. Being quorum present, we'll go ahead and move forward. You had several sets of minutes distributed in your packet for the December 2nd meeting, the December 17th meeting, the December 19th meeting, January 3rd, and February 11th.
Make a motion to approve all of them as written.
Got a motion from Jerry to approve as presented. Is there a second?
Second.
Second by Bill O'Mara. Any questions, discussion, deletions, or changes? Hearing none, all in favor signify by saying aye.
Aye.
All opposed? Ayes have it.
Mr. Chairman,
Yes.
I did want to make note that we did not receive any public comment, just so that we can get that in the record.
Okay. I appreciate that, Sherry. Thank you.
Thank you.
Okay. I want to take just a minute to recognize both Jerry Powell and Betty Pendergrass. You know, this may be their last regular called meeting, but it's both an honor and a privilege to recognize the two individuals. Their decision-making ability, their dedication, their leadership, and unwavering commitment have left an enduring mark on the County Employee Retirement System. Betty Pendergrass and Jerry Powell have each played a pivotal role in shaping the future of CERS, and their tireless efforts have strengthened the foundation upon which this system stands today. I want to point out, Betty's journey of service began when she was first elected the CERS representative to the Kentucky Retirement Systems Board back in 2013. She returned in 2017 and was re-elected in 2021 and went on to serve 2 consecutive years as chairman of the CERS Board of Directors. Following the successful passage of House Bill 484, the landmark legislation that granted CERS the self-governance it long deserved, her steady leadership and vision helped establish the policies and structures that continue to guide our work today. Jerry joined the CERS board in 2017 and was re-elected in 2021 and has served as vice chair of the CERS board and 2 terms as chair of KPPA. His leadership was instrumental in the passage of House Bill 484 and in securing the long-term financial health of CERS. His strategic mindset, dedication, and advocacy have ensured that the pension and health insurance benefits for both hazardous and non-hazardous members will remain secure for generations to come. Together, Betty and Jerry have been champions of fiscal responsibility, transparency, and accountability. They fought for the best interest of the employees and the retirees we serve, always prioritizing the well-being above all else. Their experience and guidance will be deeply missed, but the impact of their work will never be forgotten. On behalf of the board, the staff, and the thousands of members who rely on this system, I want to thank Betty and Jerry for their leadership, your vision, your unwavering commitment to the future of CERS. Your legacy will endure in policies you helped shape, the security you provided our members, and the strong foundation that you've laid. With that, I know both Jerry and Betty are not with us, but when we next see them, I think Sherry has a presentation to give them, and I think I heard something about Ed was going to hold Jerry's hostage. So I wanted to take time to thank both of you all for your service and recognize all that you all have done over the past several years to make CERS what it is today. So
Thank you very much. That was extremely kind words.
Yes, thank you very much. It's been an honor to serve in these positions.
Bill, I see your hand up, sir.
Yes, if I could just take a moment to express my gratitude to both of them. As a new board member, I really reached out to both of them to get their historical perspective and very wise advice, usually making me think even more than before I called, given the perspectives that they could furnish me. But it was through their guidance that I got my feet established, and I just wanted to thank them personally for their impact.
Thanks, Bill. You are trainable.
Bill,
Thank you, Bill.
I second your comment, and certainly I think I leaned on both of these people to learn more about the background, and I think particularly the context of our responsibilities and previous experience and insight was very helpful to gain a foothold and really become a full-fledged member of the group. So thank you both.
Thank you, sir.
I just want to remind both of you, we still have your phone numbers.
And you're still welcome to get hold of me.
As long as it's not during fishing time, right, Jerry?
Well, I don't have any set times anymore. You know, I'm starting to grasp the concept of retirement now.
Okay. With that, I want to move on. You know, we've got a long agenda today. I want to move on to the Personnel Committee. JT, I believe you have a report for us.
Yes, as you see in your notes, we reviewed several things. One of them needs action. First is that we reviewed and approved the CERS CEO performance plan. Lori's here are available to answer questions if anyone has them. Oh, good, no questions. So that one is the one that we recommend that now the full board would ratify our actions that we took at the committee, at the personnel committee.
Okay. Anybody have any questions on this topic for JT? If not, I'll entertain a motion to approve the
I didn't see anything in the board packet. I didn't see a document on what is in that performance plan.
Okay.
Yeah, the document, I don't think the document was included. But I can, if it'll help, I can briefly kind of go over what that plan looks like. So it basically moves the plan to a calendar year, and it mimics what the state is doing for other 18A employees. The plan starts in January, there's a mid-year in July, and then the year ends in December. And within that plan, all other state employees have 6 core competencies that are kind of outlined by the state personnel cabinet. And then anybody that supervises employees has 3 manager competencies as well. And so that's kind of the base of the plan. And so the CEO's new plan would include those, along with 5 to 7 job-specific tasks that are also included.
Thank you, Lori. Anybody have questions for Lori? Okay. Again, I'll ask for a motion to approve recommendation of the Personnel Committee.
Also move.
Have a motion from Dr. Hackler, second.
I'll second.
Thank you, Jerry. We have a motion and a second. Any questions or discussion? Hearing none, all in favor signify by saying aye.
Aye.
All opposed? Ayes have it. Thank you, JT. Your next topic?
We also at that time discussed the upcoming election, which has now happened. Or about to happen. The results will we'll have by March 15th. And then Ed went over a plan to begin a different way of capturing a trustee's education time. And that was received favorably, but that's not a thing that requires action.
Okay. All right. I think Kristen has a report later on with regard to election updates, so we'll go ahead and move forward. Have any other items for approval,
No.
JT?
No, sir.
Okay. With that, we'll move to the Finance Committee. Bill, take it away, sir.
Thank you. We had our regularly scheduled Finance Committee meeting on February 17th. And we had two items to bring before the board. First is hazardous duty request. There were a total of 9 that had been requested, reviewed, and recommended by staff. And Mr. Surratt is here for any questions, but we bring that forward for ratification to the full board.
Okay.
So moved.
Second.
A motion and a second. Any discussion or questions? Hearing none, all in favor signify by saying aye.
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 All opposed? Ayes have it. Hazardous duty requests have been approved.
Second, we had the Finance Committee strategic plan to finish, and we went over several components and had discussion, and we have brought that forward. It was unanimously approved by the committee, and we bring that forward for to be included with the total board strategic plan and bring it before the board for approval.
Okay.
And to save time, we could leave that one for final approval when we come to the board's strategic plan later on today's agenda, since the committee approved theirs unanimously. Basically, we added some measures and targets to the plan they had brought to the board before, but we can finally approve it when we come to that item later in the agenda, if it will save time.
That will be fine. Okay. We have quarterly financial, I'm sorry, Bill, go ahead.
Well, we had a good presentation from XTP, who looks at our contract governance, custodial bank compliance, service provider compliance, and contract optimization. Their fee is any savings over 2 years. We had a good discussion about the advantages that might be had by this, but also questions about the procurement that we feel need to be investigated before bringing before the whole committee. And then we had the financial reports for the quarter, and Mike Lamb is here to discuss those.
Thanks, Mr. O'Mara. I'll touch base on 6 topics related to the C financial reports. The first one wasn't in the Finance Committee. It has to do with the GASB 68 and 75 reports. I wanted to let the trustees know today that those reports were presented to the KPPA Audit Committee on February 25th. Those reports were accepted by the Audit Committee and sent to the KPPA Board for their final consideration and approval during their upcoming March 20th meeting. In the meantime, the draft reports and Excel schedules have been placed on the KPPA website for the employers and their own external auditors to review as needed. These draft reports are also in the appendix of your board books today. The second item will get started on page 48, and near the bottom of that, you'll see the fiduciary net position for the C system is 19.1 billion at the end of December. That's 8.83% or approximately $1.5 billion higher than December 2023. The two pension plans total 13.6 billion and the insurance plans total 5.5 billion. In the middle of that page, you'll see the investments at fair value increased overall by 8.4%, or 1.4 billion. The pension plans are up 9.08% by themselves, and the insurance plans are up 6.76% compared to the prior December. If we move down to the middle of page 51, which is the combining statement of changes in fiduciary net position, the little white space under 2025 total shows 310 million. That represents the change, in this case, an increase in the fiduciary net position through the second quarter of this fiscal year. If you compare that to the prior 6 months total of 775,000, so we've still increased, but not as much as we did in the prior year. This year's increases are driven by the net appreciation in the fair market value of investments for the most part. We can look at some of the components of that increase on the contribution reports on page 52. In general, through the second quarter of fiscal year 25, member contributions are up 6 million, while employer contributions were down 46.5 million. Member contributions are up because payroll for both the CERS plans is up 136 million or 7.17%, with 1,534 more active members compared to the first 2 quarters of the prior year. And the employer contributions are down because the rates for CERS non-hazardous have decreased from 23.34% to 19.71%. That's the largest factor in that. And the hazardous rates have decreased from 41.11 to 36.49. Net investment income for the two pension plans was 153.9 million and 15 million or 10.72% higher than the first 2 quarters of the prior year. Both plans paid out 61.4 million more in benefits, refunds, and admin expenses than the prior year's first 2 quarters. And this results show that yellow line, the net contribution line, the CERS non-hazardous pension plan had a negative net contribution of 17 million, while the CERS hazardous pension plan had a positive net contribution of 33.2 million. If we remove the net investment income of 112.9 million and 41 million respectively from both of those plans, the CERS non-hazardous plan has negative 129.9 million cash flow, and the CERS hazardous plan has negative 7.8 million. The insurance contribution report right there shows that the net contribution line has CERS non-hazardous negative 9.5 million and the CERS hazardous insurance plan at negative 20.8 million. If we remove the net investment income from those plans, you'll see that the bottom chart has negative 51 million and negative 39.7 million respectively in cash flow. Both insurance plans have lower employer contributions due to rate reductions and less in the Humana gain share. That's what I have on the financials. The next item is number 5 on my list. It's the outstanding invoices by type. It starts on page 53. This report is what you see every quarter. It was also shown in the Finance Committee meeting, and as it shows at 12/31, the outstanding invoices were 2.2 million, whereas at 9/30, the invoices were 3 million. So it's dropped about $1 million in the quarter. I want to note that the top 10 invoices are listed there. Top 10 employers with open invoices are listed there. Several of them are with legal. And I do want to point out that if you remove the ones that are with legal, most of those top 10 are now under $100,000 in outstanding invoices. So I did put a second report in here. It's on the next page, Sherry. This is an experimental report that the Open Employer Task Force is looking at. It shows a few other items that are not in the other reports. It shows the number of past due invoices, how far they are past due in summary by various buckets on the left-hand side, the number of employers who have past due invoices in those buckets. And so I wanted to present this to you today to kind of give you a comparison of what's been presented, maybe take some feedback of other things you might want to see, and to also acknowledge the amount of work and effort that the ERSI department and the legal department have made in the last 7 months related to open employer invoices. So at the bottom of that page, it shows the amounts that were open at the end of June 30, 2024. And so for CERS in total, there were 1,625 invoices past due across 292 employers, totaling $3.6 million. It's broken out in those buckets below. And if you look at the 3 to 5 year bucket and the over 5 year bucket, we had 800,000 in each of those buckets. And for the hazardous, we had over $1 million in the 5 year bucket. And if Sherry scrolls up just a little bit more, at the end of February, so I took the February reports and put this chart together, there's only 715 invoices past due across 188 employers, totaling $2 million. So in that period of time, the amount of invoices have been cut in half, the employers have dropped by 100, and the outstanding amount that's past due has dropped by $1.6 million. You also see in that 3 to 5 year bucket and the over 5 year bucket, it's 800,000 and 419,000, and the over 5 years is 400,000. Most of those buckets that are old like that are the entities that are being addressed by legal. Some of them are in litigation, and some of them are disputing some of the invoices for legal reasons, and so being resolved. So I wanted to show that progress that's been made related to the open invoices, and there's still several things to be done, lots of work to be had, but we do have that task force that's working on various things in the present as well as things to address in the future. The last item on my list was the admin budget to actual. My summary notes are there for you to read, and I wasn't going to elaborate on them for time. And that's a couple more pages down, Sherry. I think I didn't note the page number that was on. It's probably closer to 60.
61.
61, yes. That's what I have today. I'm open to any questions or concerns or comments.
Mike, biggest.
Thank you, Mike. And I want to thank the task force and all the people behind it for all that work just in a very short amount of time. And we really appreciate that. Are there any other questions financially related?
Ms. Pendergrass has her hand up.
I really like this aging schedule approach. I think it gives us a lot of useful information about the invoices rather than just the simple list of the categories that they're in. I really think this adds some important information. Thanks, Mike, and the task force.
I'll echo everybody's sentiment, Mike. I know that was one of the issues that you all have been working on and the Finance Committee's been focused on over the last year, but that reduction over a quarter is quite impressive. We appreciate the hard work. With that, Bill, do you have anything else on that needs action?
That concludes the report. Thank you.
Okay. Thank you, Bill. That will move on to the Investment Committee and Dr. Hackberg. Dr. Hackberg, if you want to begin, you've got a long list.
Yeah, we had a very active meeting on February 26th. We had a number of minutes to take care of, to approve those, plus we have basically are presenting this afternoon 4 action items. And of course, after the action items are dealt with, we'll have a report update on the performance of our portfolio, as well as some conversation about the economic outlook, given the change in administration and the potential impacts it might have on the economy as well as on our portfolio. In terms of the action items, I think we probably should handle these individually. They are significant recommendations, and so I'll just give a brief highlight of each one as we go through those, then hold a vote on each individual action and have an opportunity for discussion of those recommendations. These were all unanimous recommendations of the Investment Committee, so I think we can approach it that way. The first recommendation deals with the large cap equity portfolio. The recommendation by the KPPA Investment Office, as well as recommendation by Wilshire, is an allocation of the CERS large cap equity to two new investors, investment firms, investment managers, I should say, JP Morgan and T. Rowe Price. We had a considerable discussion about this recommendation. We also sat through some presentations and found to be very comfortable with both of those investment managers. And I think it's certainly a recommendation we feel quite positively about. And so in that regard, I move that we accept this recommendation, and with maybe a second, and then we can have a discussion, Mr. Chairman.
I'll second.
Okay. So is there any discussion? Steve, are you on board? Yeah.
Yes.
Okay.
Yeah, I'm happy to cover, highlight or go into any detail. Joe is on as well, and Joe obviously did the heavy lifting on both of these recommendations, but happy to take questions, or I can provide a bit of an overview for you.
Steve, I think it'd probably be helpful if you just highlight the difference in the management styles and what their past performances have been. Probably be a good starting point.
Sure. I'll give you a little background, and Joe can jump in. Page 68, please, Sherry. Thank you. And so as Dr. Hackbark mentioned, that the genesis of these investments recommendations was really part of our continuous review of the structure of the overall public equity portfolio, with the goal of ensuring that we have an optimal allocation and exposure, as well as what we view as efficient utilization of our risk budget. And through this process, staff made the determination to recommend retiring the existing internally managed U.S. large cap factor-based public equity portfolio. You often hear us refer to that as the scientific beta portfolio, because it's modeled after scientific beta's U.S. 4-factor equal weight index. These factors have not been rewarded in the portfolio for any substantial period of time, and staff and Wilshire both felt it was not anticipated to change in the market opportunity dynamics going forward. So Joe and Wilshire conducted a very comprehensive and competitive search process that resulted in the recommendation, as Dr. Hackbark mentioned, to invest up to 6.25% of the total CERS global public equity allocation in the JP Morgan US large cap core equity strategy, and up to 6.25% in the T. Rowe Price US structured credit research equity strategy. And obviously both of these are subject to successful contract negotiation. Staff views this, the addition of these two portfolios will create a more efficient public equity portfolio with a better risk reward profile and increased diversification, as both strategies have low to negative correlations with the existing portfolios, and the strategies are complementary to each other, providing better overall outcomes than either strategy would independently. And I'll let Joe get into a little detail on the differentiation between the strategies of the two portfolios and their construction.
Appreciate that. So Steve gave a good synopsis. So really the genesis of this was we wanted to kind of eliminate those structural biases that the scientific beta portfolio brought in, and wanted relative outperformance to be driven by stock selection. Both these strategies do a really good job at they're very style neutral. They don't take any factor bets. So stock selection really is the primary driver of relative outperformance. They've been able to add value in both up and down markets. Like you said, they complement one another well as far as the return pattern. T. Rowe Price is a product that is kind of analyst driven, so it's a little different. Its portfolio is a combination or an aggregation of multi-analyst driven portfolios that's overseen by a PM team of 5 individuals. The strategy takes a very small incremental bets across the portfolio, tracking errors about 1.75%. So you pair that with JP Morgan, which is kind of your more traditional as far as team orientation, with a PM that sits on top of an analyst group, with the PM being the primary decision maker. It has a little bit higher tracking error, so they take a little bit larger bets. It's a little more concentrated. So when you blend those two portfolios together, you have an expected increased return at a much smoother return path than if you were to go with JP Morgan alone, for instance. They are not, while correlated, they're not correlated very heavily, so you're not doubling up on your bets by employing both these products that, like I said, and like Stephen mentioned, they complement each other well. And so we just think this is a better way to build the portfolio going forward from a structural standpoint, not to embed a structural bias that, and sometimes will be a tailwind for you, at other times it's going to be a headwind. We don't want to put the portfolio in that position at this time. So I don't know if that's what you were looking for, Steve, or if you wanted more detail.
No, I think that's great. It just to highlight, as the memo states, that the funding for both of these mandates would be initially from the scientific beta portfolio, and we would anticipate additional funding coming from the internally managed S&P passive portfolio.
Okay.
I might just add that I think the recommendation and the background of the recommendation from the staff was exemplary and represents a really good start in how their presentation to the committee was just, I think, very impressive. We also had sessions with J.P. Morgan and T. Rowe Price. So I think the committee felt very strong, very comfortable with the recommendation, and really would like to compliment Joe and Steve and staff, and also support from Wilshire for the development of this recommendation, the presentation they made to the committee, and I think it really helped us in resolving her recommendation. So thank all of you for your very hard work on this recommendation.
Anyone else have any questions on this topic? If not, we've got a motion and a second to accept the recommendation from the investment committee on a 12.5% total allocation of the U.S. large cap equity investment allocation, approximately half going to J.P. Morgan and half going to T. Rowe Price. All in favor signify by saying aye.
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 All opposed? Ayes have it. Next.
Second item, as indicated on the for this afternoon, is a real return recommendation. The investment office has recommended an additional $70 million be committed to Arctos American Football Fund. This is an opportunity that just has arisen. They went through a very good presentation about the reasons for that, and Anthony did a good presentation in that regard, just like on the previous one. And the committee voted unanimously to recommend to the full committee here this afternoon to accept that staff recommendation of an additional $70 million commitment to Arctos American Football Fund. And maybe Anthony or Steve, any more comments about that would be helpful.
Sure, I'll give you a brief overview, and Anthony can jump in with more details. So this was one of two real return investment recommendations that we made to the committee that were both approved unanimously, and they're both recommendations to increase capital commitments to existing managers that were previously approved, and specifically for Arctos. So that's Arctos Sports Partners. Excuse me. The additional investment with Arctos, and sorry, sure, this is 162, might be helpful. The additional investment with Arctos would be committed, as Dr. Hackbart mentioned, to what is their newly launched Arctos American Football Fund, AAFF. And this fund was established in response to the NFL announcing in August that it would open up to private equity investment with a very select group of 4 investors, Arctos being one of those. CERS will have a small indirect investment in our existing fund, which is the Arctos Sports Fund 2, to this new fund, AAFF. And staff recommended an additional investment into AAFF to have a more meaningful exposure to the unique asset that is the NFL. When we originally brought Arctos before the committee and before the board, we anticipated that the NFL would open up to private equity, and that Fund 2 would have an exposure. Both the way that the NFL requires structuring, as well as the timing as far as the Arctos Sports Fund 2 necessitated that Arctos open this new fund. So in order to have the exposure that we originally thought of as across the major U.S. sports leagues, we anticipated some being in the NFL. And so this additional commitment would allow kind of what we originally proposed as the exposure across funds. When fully funded, this would represent an additional 30 basis points of assets and provide roughly 35 to 50 basis points of NFL exposure for each plan. Anthony, I don't know if you want to weigh in with any additional comments.
Anthony, I can't tell if you're there or not.
He's on.
Okay. Well, Anthony's, I guess, trying to get hooked up. Two things I'll point out that I took away from the presentation. I really support this. First one is, unlike some of the old legacy programs, this one has a exit strategy about 10 years down the road. So it's not something that we get stuck with and having to, carry on the books for an extended period of time.
And at the end of 10 years, we could stay for
Yeah, we could stay
disengage.
Yeah. I thought that was very important, and I think it's one of those topics that should be important going forward. The other thing I took away was, I found really interesting, is that the media package that the NFL pays 100% of all the expenses of all the football teams out there before they ever sell the first ticket. So from a recession-proof asset, I think that's one of the things that you look for in a real return asset. That was a pretty good marker as well. So, Steve, I don't know whether there's Anthony now. Anthony, you got anything you want to add?
Yeah, can you hear me or no?
Yep.
Yes.
Okay. Yes, I think we talked previously about how sports is a kind of unique asset and fits our real return profile in terms of less correlation and good ties to inflation and contracted cash flows. And the NFL is the epitome of that. And that was one of the reasons, that was the main reason why we wanted to have more exposure to that. It is unique among the sports leagues in terms of its revenue and profitability. And so that's the major reason that we were interested once it was approved for institutions to be able to invest with the league. So, but happy to take any questions if you guys have any.
No, and I would emphasize exactly as Lyle said. I think one of the unique things specifically about Sports Fund 2 as well as the new AAFF is that Arctos has part of the agreement is that a liquidity option, while we expect realizations, I think, 65, 75%, the duration looking at a 5 to 7 type year. With these types of investments, you always have a tail, something at the end, right? That, as Anthony always says, one of my favorite comments is, some of our investments in these types of spaces are old enough to drink now. And so the fact that they structured it with a liquidity option after 10 years that's available to all investors is pretty unique. And I think makes a compelling case for the investment.
And that's right. They have a lot of background in the secondaries, and that's one of the founders of Arctos. That's his background in structuring deals, and that's something they put into a lot of their deals. The NFL doesn't allow that yet, structuring, but for building that into the fund structure, they have the liquidity provisions for sure, because that's something that they think is important as well.
So, Mr. Chairman, with that background, I would move on behalf of the investment committee to approve the real return recommendation of the staff to commit an additional $70 million to the Arctos American Football Fund.
I have a motion. Do I have a second?
Second.
Second.
Second by JT. Sorry, Bill, he beat you to it.
Well,
Any questions or discussion? All in favor signify by saying aye.
aye.
All opposed? Ayes have it. Motion to invest an additional $70 million with Arctos is approved.
The next recommendation, also a real return recommendation from the investment staff, and discussed at our previous meeting, was an increase in the American River Fund of $70 million. This is a real return recommendation. Again, we had a good discussion of this recommendation, and the committee voted unanimously to recommend to this board the additional investment of $70 million to this fund. And Steve, any additional comments here?
Sure. So just a little background. In February 2023 is when both KRS and CERS committed a total of $250 million to the fund. Approximately 75% of that commitment was called in October 2023. So pretty rapid deployment for this asset class, and done very prudently. And that investment has subsequently yielded about 10% as anticipated in the initial recommendation. And we also receive cash distributed quarterly, so it has liquidity provisions as well. And the investment thesis for the additional recommendation really remains the same as the original, which is that the marine transportation supply demand dynamic remains extremely favorable. Demand for the essential cargoes that the fund's fleet transports is strong, with utilization remaining near 100%, and new vessel supply is largely at replacement levels for an aging inland marine fleet. So the thesis is the same. I think it's much like the recent rail car investment that we did. The transport is a really interesting place to be for real assets. We think it's the dynamics and the support are very supportive to the industry. And when fully funded, this would represent, again, an additional 30 basis points and provide around 1.2% exposure for each plan. I'll pause there for questions, or if Anthony wants to add any additional color.
Sure. Yeah, I think, like Steve was saying, the supply demand dynamic for in the marine, I think, is even better than the rail dynamic. That's one of the reasons why we presented that first. There just are not a lot of shipbuilding going on in our country, and I think some of y'all may have heard President Trump mention in his speech recently about enhancing that, because that's just an area of investment that has been a bit neglected. But it's going to be difficult to bring back because that's not something you just turn on quickly. So, but that is an area that is of need going forward, and I think that this fund is actually benefit or in place to benefit as well, because they bought the North American division from Maersk last year that contracts with one of the military, with the government agency and military, their U.S. flagged boats, the supply military bases overseas. So they have some, they could have some benefit, or already do have exposure to that area as well.
Yeah, and similar to the Arctos, this has a lot of the characteristics we look for in real return: contracted cash flows, very low to negative correlations to the bulk of our portfolio, which is in public assets, and has some level of inflation sensitivity to it. So it ticks a lot of the boxes. Obviously, we're very constructive in recommending an additional commitment.
Any questions or further insights requested of us? Steve or Anthony? If not, I would, on behalf of the investment committee, move the acceptance of this recommendation for an additional $70 million investment in the American River Fund, Mr. Chairman.
Okay. Have a motion. Do I have a second?
Second.
There we go, Bill. Thank you, sir. Having a motion and a second, are there any discussions or questions? Hearing none, all in favor signify by saying aye.
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 All opposed? Ayes have it. Okay.
Thank you.
Thank you. The fourth action items from the investment committee is the public equity benchmark recommendation. The staff, working with Wilshire, has come up with a recommendation to adopt the MSCI All Counties World Investable Market Index as a substitute for our current comparison. They feel it's a better alignment and a better benchmark to use for assessing our progress and so forth. And so again, turn it back to Steve for any detailed or recommendations or discussion. Right.
Sure, I'll briefly cover this. Sherry, I believe 157 is the page. Right. As Dr. Hackbart mentioned, the committee unanimously approved staff and Wilshire's recommendation to adopt the MSCI ACWI IMI, which is the Investable Market Index. And that really is as the IPS performance benchmark, so what we're measured against for the global public equity asset class. And currently, we're using the MSCI All Country World Index Net USD as the performance benchmark for the public equity, global public equity asset class. And as part of the review and analysis of the IPS performance benchmarks that we've undertaken, we've talked about the private equity. This part was in the public equity space. Staff in Wilshire determined that the current index really does not accurately represent the intended public equity investment opportunity universe and embeds an unintended bias in the global equity allocation and resulting in an increased level of tracking error. The recommended IMI index benchmark is a better alignment of the actual exposure and strategy of the portfolio, as well as the desires of the board regarding diversification, and would reduce the systemic tracking error of the global public equity portfolio. And this change originally was made as part of the move to a global public equity from a dedicated US and non-US allocations. And that was done back in 2022.
Any questions of anyone? If not, again, Mr. Chairman, I move on behalf of the Investment Committee the acceptance of this recommendation on the public equity benchmark change.
I'll second.
A motion and second by Betty. I would like Wilshire, David, Chris, you guys, if you would just touch on the importance of why realigning our benchmark indexes are a focus right now.
Happy to do so, Mr. Chairman. So Joe and I had some discussions regarding the public equity, and to Steve's point, when you did have a U.S. and a non-U.S. benchmark, you had benchmarked your U.S. equity to the Russell 3000, and your non-U.S. was actually benchmarked to the MSCI ACWI ex-US IMI index. When we moved to the global index, it was adopted as the MSCI ACWI index, and MSCI's index construction methodology is such that the non-IMI version, so the MSCI ACWI, only covers about 85% of the investable universe. So by moving to the IMI, you are capturing about 99% of the investable universe, which is much more in line with the implementation of the portfolio, reaching down into that smaller capitalization portion of the universe. And really a majority of the difference here was driven by the non-small cap component in the US portfolio. So we were able to get rid of over half of the tracking error by moving to that IMI index.
Thank you, Chris. All right, I have a motion and a second on the floor. Any other questions or discussion? Not. All in favor signify by saying aye.
Aye.
All opposed? Ayes have it. Thank you, guys.
Mr. Chairman, the last item on the agenda from the Investment Committee is an update on the last quarter portfolio performance, as well as discussion of the economic outlook for the next future, given the changes which are occurring nationally in terms of federal fiscal policy, tax policy, and tariffs, and a number of issues of that nature. We had a very rigorous discussion of those items. And first, Steve, if you would start out with a discussion of our performance for the last quarter, then we could extend that into the outlook for the economy and financial markets, if that would be appropriate.
Sure. I wanted to briefly touch, obviously, cognizant of the full agenda here. So, for the quarter, consistent with what were weaker, sorry, Sherry, page 202 is probably a good starting point. Just performance here, yes. Consistent with that, the weaker, broader markets, the CRS pension composite produced a return of minus 34 basis points for the quarter, and the CRS insurance composite produced a return of minus 40 basis points, underperforming the benchmark return of positive 6 basis points. Individual portfolio performance for the quarter was tightly grouped, ranging from down 42 basis points to down 34 basis points. During the quarter, the real return and specialty credit portfolios were the standout performers, posting positive absolute returns and outperforming their benchmark by 278 and 101 basis points, respectively. Fiscal year to date, as of the end of the quarter, the CRS pension composite produced a return of 4.54%, and the insurance composite produced a return of 4.38% compared to the benchmark return of 4.83%. January performance was recently finalized with the CRS pension portfolio returning 1.92%, the CRS hazardous pension portfolio returning 1.93%, the CRS insurance portfolio produced a return of 1.92%, and the CRS hazardous insurance portfolio returning 1.88% versus benchmark return of 1.72%. So about 20 basis points of outperformance during the month of January. We turn that page, and as we've witnessed in February and March, uncertainty remains high, with risk is seemingly asymmetric. I'm kind of looking at the red on the screens today. As markets react to policy shifts, economic data underscoring the reality of what really is a new macro environment with a wider range of possible outcomes and what we will view as persistently high volatility. So most recent economic data really calls into question both the timing and the magnitude of actions by the Fed. As we saw, the U.S. jobs report for February was released last week. Well, it showed solid job growth, but the concern was that the DOGE-related federal employee filings are not yet reflected in the February data. We also saw the Challenger job report that announced planned job cuts for U.S. employers increased 245%, the highest level since July 2020. And that was when we were in the throes of the COVID shutdown. U.S. manufacturing PMI rose slightly to 52.7, up from 51.2 in January, which seemingly has been driven at least partially by advanced purchases and anticipation of tariffs. So that's kind of a pull forward. So the realization of that will be tampered down in the months ahead. U.S. services PMI fell to 51% in February, which was the softest in growth services activity since November 2023. And U.S. ISM manufacturing PMI fell to 50.3 in February, with new orders falling the most since March 2022. So really, Trump's unconventional policies have scared investors to the point that sentiment is at levels associated with really major bear market lows, even though prices are just down. It's going to change day to day here, but down less than 10% off of all-time lows set just a couple of weeks ago. Thus far in 2025, we've really seen a big rotation in public equity performance. The S&P, which registered a 25% return last year, is down as of now almost 6% year to date, while European indices, which experienced modest gains last year, have been strong, has seen strong relative returns so far this year. That America First agenda that the new U.S. administration is following is not really translated into that U.S. equity outperformance, as the S&P has trailed China and European indices, although bond markets in the U.S. have rallied while government bonds in China and Europe have declined. What I used during the meeting was an interesting thing that we're seeing a lot of volatility and uncertainty, which is usually not conducive to strong risk on in markets. And it's led to that disorder in both investor moods as well as confusion around policies yet to come. And the acronym we used was T2D2, which is tariffs and taxes, along with deregulation and deportations. Really, the scope, reach, and timing for all of the policy shifts are going to matter to how markets and the economy play forward. We've seen recent reductions in the GDP now forecast in Atlanta, which had a little bit to do with the rise in imports, which we thought was front running to some of the tariff talk. But the theme for the remainder of the calendar year certainly seems to be elevated volatility and uncertainty, concerns around the U.S. consumer, and we've actually heard, now you hear talks of recession again. Whether that all comes to play or not, I think it's a little early. How much of this is posturing ahead of a game theory with our foreign trade counterparties, and how much of it actually gets implemented in the long term is going to be pretty determinant about growth and markets going forward.
I think one thing we talked about in the committee was certainly, I think we understand the markets like stability, and what we have is just the opposite. We have an administration that really hasn't stated its policies. They just have actions announced various days, and a few days later another policy. Tariff policy seems to be vague and uncertain, and so they've created an environment which is just the opposite of certainty. So I think that becomes a real issue as we look forward to stabilization and more security and stability to really help the markets decide what direction they're going to
Absolutely.
Fed.
One of the benefits to the portfolio that, you know, if we look at this relative to the last time we saw significant drawdowns, is that you know, as we advocated and you guys implemented in your last asset allocation, fixed income is actually performing as a ballast this time, right? As opposed to you know, the last significant drawdown in public equities. So we are seeing some buffering of overall portfolio performance from benefiting from the reduction in yields, increase in prices in core fixed income and in the fixed income market in general. So that is a benefit. So the timing of increasing the allocation to fixed income was beneficial, at least here in the short term. But you're exactly right. The markets love certainty. They hate uncertainty. As we see, we're trading off of headlines, which never is a sign of a healthy market. Unfortunately, I don't see a lot of clarity as to getting out of that anytime soon. I would say our one, you know, where we're more constructive is at least in the U.S. Absent kind of that uncertainty, the fundamentals of the markets in growth are still pretty sound. It'll take a while. I mean, we still have, you know, the employment picture is still solid. You know, we still have an active Fed, which can take action and now has room to take action if necessary. But it's going to take some certainty in market and some resolution of some of the outstanding issues to really get directional.
David, you know, Wilshire, you all want to, I know in our investment committee meetings, you all did a pretty good job of explaining the risk premium issues that are going on in the market right now. If you just kind of touch on that.
Yep. Yeah, happy to do that. Jerry, if you want to go out to page 177, please. This, we develop capital market assumptions, as you all know well, and those are 10-year forward-looking assumptions. So a lot of the discussion we just had, Steve put it well, you know, when you said, Steve, something like we're trading off of headlines. Clearly, the market trades off of headlines every day. Interestingly, from a bigger picture, longer term perspective, these are our capital market assumptions at the end of the calendar year. So not tied into today's headlines, but tied into true valuations and what we viewed things as at the end of the year. So equity market valuations, current yields on fixed income, and the change in the yield curve over the past 2 years or so. And what that comes down to is, if you look in that top green section, although I said these are 10-year forward-looking assumptions, we revisit the modeling of this every quarter end. So we show that to you, and you see some modest changes in those quarter by quarter because they are looking out long-term 10 years. Halfway down that, in the green circle, 3 columns over, titled December 2024, if you look about halfway down, you'll see a core bond expected return of 5.20. Think of that as over the next 10 years, we expect better than 5% out of just investment grade fixed income. Outside of that, you have high yield, you have private credit, higher expected returns from both of those. But where we expect lower returns is in particular from equities, but even more so from this U.S. market. And that is driven off of how strongly the U.S. market has outperformed everything else historically, and for much of the time, actually, all the way back to the end of the credit crisis, with the exception of a few little points of dislocation otherwise. But U.S. stocks looking forward, we expect low returns, 4.35% over the next 10 years. So the equity risk premium that the chairman referred to, that is the difference between stocks and bonds. And if you think about stocks minus bonds, generally, that would be a positive number, because we all expect investments in equities and the ownership of businesses to outperform investments in debt or loaning investments of capital over time. This is inverted right now, where we have a negative equity risk premium of 85 basis points. You see that highlighted at the bottom right-hand side of this chart, just simply meaning that we actually expect investment grade bonds to outperform stocks in the U.S. over the next 10 years. So that position, there's a lot that goes into that beyond just where we are with geopolitical issues and current administration issues. This is a long-term forecast where we are expecting more out of fixed income. And I will say that over the past year, we've had a lot of conversation with this, and you've done a lot in this category of continuing to focus on your private credit investments, your publicly traded credit, and the other things in your portfolio beyond equities. So I think you have good reflection of this in the things that you've done and the staff's done, and we've all talked about over the past year. But to put maybe one more shed one more watt of light on that whole story. If you go to the next, let's see, it's slide 178, please. When we say 4.35% for stocks over the next 10 years, it's easy to think, how could that be possible? But that does actually happen. We do have decades, and we have had decades that have often been referred to as the lost decade, where stocks have gone nowhere. And if you look at the very bottom of this chart, that green line, this is a chart of decade returns to the US stock market. You can cut these a number of different ways. We happen to produce this one based on just typical well-known decades that come right off the calendar, 70s, 80s, 90s, etc. But that bottom line, the green line, that is the decade of the 2000s. And if you look to the far right of that, stocks in the 2000s over the course of that decade went absolutely nowhere. So that is coming off of the highs that we had at the end of the 1990s. We had some good recovery in the first half of the decade. Then we hit the global financial crisis and wiped it out again. And by the end of 2010, we had essentially nothing out of stock investments. If you look at the top two lines, 1980s and 90s, orange and red, that's where we came from before we hit that lost decade. We came from very strong returns in the equity markets in the 1990s and even in the 1980s. So this does not drive our forward-looking return assumption, but we find this as helpful to look at as a reminder of what can actually happen. Yes, stocks can have a go-nowhere decade. Stocks can underperform bonds for a period of 10 years. And as we look forward today, that's what we are expecting. So we'll continue to keep you posted on that, but that's the negative equity risk premium that the chairman was referring to.
Mr. Chairman, that concludes our investment committee report.
Okay. Thank you, David. I appreciate that explanation.
Yes. Thank you.
Okay. With that, we'll move on. Ms. Betty, the CERS strategic plan.
Thank you very much. We'll get started on this one. This section of the board book starts on page 293. And Sherry, if you'll let me share, what I'm going to show the board today is a Word document so that I can, if you have any edits that you want to make in wording, we can do those on the fly. And I'm talking while I'm clicking. Now I've lost the share button. Oh, there it is. Okay. Now you should be able to see my Word document. Okay. I want to give just a little bit of background. We started on this back in March 2022 with the board looking at a template, if you will, for how we wanted to approach the strategic planning. I've included in board packets a copy of the Colorado plan that I used to structure the particular format that the board selected in March of 2022. And then we handed off the work to each one of the committees to look at their individual areas of responsibility and their ability, what they wanted to accomplish with each one of those committees. I want to start on this page that outlines our mission, values, our mission, our vision, and our core values. Those 3 paragraphs are particularly important to how the strategic plan comes together. Does anybody have any suggestions for edits on any one of those paragraphs? Okay, now down at the bottom of that page, we have strategic goals. These are the goals that we handed off to each one of the committees. Goal number 1 was the actuarial committee's responsibilities. They wanted to strengthen the actuarial determination or actuarial administration to achieve full funding of the CERS plans. Goal 2 is the investment strategy, enhancing the investment management to support prudent portfolio performance and compliance oversight. Goal 3 was the Finance Committee, who is collaborating with the Kentucky Retirement Systems and KPPA, I might add, to develop a cost-effective administrative cost budget, financial management, and cost allocation policies. And then we had several administrative type functions. The Personnel Committee is wrapped into the administrative function, and we'll take a look at how we can provide the structure to support efficient governance for CERS post-retirement plans. Then if we go to the first goal, this came from the Actuarial Committee. They discussed this at length. They actually approved their objectives, measures, and targets back in November of 2022. And I'll head off to Mike to ask him if he has anything he wants to add, edit, polish on the actuarial goals, objectives, measures, and or targets.
Betty, real quick, I noticed down on objective C, you've got a target date of January 2038 as far as 100% funding. I would suggest we need to make that date mirror what has been set forth by the legislature, which I think is 1940. Well, I'm lost a decade right there. Not just a 10 years, whole century. 2049.
I think when the Actuarial Committee looked at this, the 2038 was the projected pay down that was in the actuarial report. And that's open for discussion. Do we want to use what our actuary is telling us we can achieve? Do we want to be more aggressive than what the legislature says we got to do, if you will?
Have room to do.
So that's open for discussion. Jerry, you've got your hand up.
Legislate.
I think the difference there is the funding levels between C and K. And that's why the 2038 is for the C system, 2049 for K. And because the legislature would be setting that for the K system, not necessarily for the C.
Good point. I'm not sure that the General Assembly actually discussed a target for the C plans. They may have. I don't remember.
My understanding is that they did, and it's 2049. Because that's what seems to be represented in the actors and the actuarial.
So let me kick it over to Mike. Mike, you're the chair of the Actuarial Committee. What's your thoughts on that date?
I think to quote the legislator, they were laser focused on the case.
Do we have Mike with us?
Yeah.
Which Mike?
Sorry, Mike. I think you got it for a minute.
Our trustee, Mike.
Well,
Mike Foster.
Yes, Mike Foster.
How about we?
Looked like he stepped away from his chair for a minute.
Yeah, he did.
Okay, any input from other trustees while we're waiting for Mike to come back?
I think probably what we need to do there is just verify what the legislature has dictated as far as the full funding target, and just make it match. I'm sure Ryan or somebody, the staff can pull that up pretty quickly, but I'm pretty certain that's the drop dead date.
2049 is the end of the 30-year amortization period.
Right.
That was redefined in 2019.
Yep.
Which is why it gets to 2049.
Yep. Did you catch that, Betty?
Yes, I did.
Okay. Page 3.
So one problem with tying our target to the legislature is when the legislature changes that 30-year amortization, which they do on a regular basis, then that means our target gets moved out. Do we want to do that, or do we want to match up with our actuarial reporting?
I think, Ron, did you say you just?
Yeah, I think it's here, 2049 is what we're having put on pens. So give me a pause. But yeah, 2049, now obviously they can reset that, but that's the current assumption based on our estimates.
For K or C?
This is the C study on page 3. Rebecca, I'm sure she has a similar document pulled up. Yep.
I'm pulling up the projections for pension for K non-hazardous. It's 2049. That's when they're doing projections.
Okay.
Yep.
June 30th.
Yep. End of the fiscal year. I understand what you're saying, Betty. The legislature can adjust that, change it, whatever, dictate that. You know, it's like I've expressed to several legislatures over the last years. They're in charge of those things. We just deal with the hand we're dealt. Right now, from my perspective anyway, the June 2049 is the hand we've been dealt.
Anybody object to changing it to 2049? Okay, I don't hear any. Any other edits, polishing we want to do in the actuarial area? Okay, next goal belongs to the investment committee. They have the longest list because we put in a number of measures and targets for some of their objectives. The board has seen this list before. The investment committee approved this in December of 2024. We brought it to a meeting of the board for the board to approve, and then I dropped it into this consolidated approach. Are there any additional questions, edits, concerns on any of the objectives for the investment committee? Dr. Hackbird, anything you want to polish in this area?
Not really. I think we've been over this before, so I think we're fine.
He indicated he was good, Betty.
All right. Yeah, I heard him. I was waiting to see if any other trustees had anything to add.
Anybody got anything else to add on the investment side? Okay.
Goal 3 belongs to the Finance Committee, and as Mr. O'Mara indicated, the Finance Committee finished their strategic plan at their February meeting on the 17th. We added targets and measures to their objectives. We can take a little bit more time to go through this one, since this is one with measures and targets that the board has not seen yet. Their first objective is working with the CFO to work on the annual comprehensive financial reporting system and process. We added a measure to look at when the communications with the external audit firm should happen and what types of communications we should have, and those are the 3 targets that we have included in that particular section. And one of those that for me is important to stress is that we have a mandate from the Kentucky Finance Administration to deliver the audit report and our ACFR, our ACFR, to the Kentucky Finance Administration Department by specific due dates each year, because our reports are included in the Commonwealth's overall annual report, and they have to have those by a certain date so that the Commonwealth can apply for that GFOA Certificate of Achievement in Financial Reporting. So we get that every year. It's also important to the Commonwealth to get that award every year. So we are a cog in that wheel. Another measure that we added was that we get our report submitted to GFOA by December 31st, which is a GFOA deadline to make sure that we can qualify for that certificate. And we want to be able to continue to get that certificate every year. This is our first year of CERS issuing an ACFR, so this will be our inaugural certificate after GFOA has a chance to review it. GFOA always provides comments on those reports, and the investment committee thought it was important that we take those GFOA comments, work them back through our policy process, and if Mike has any issues that he wants us to address formally, to address any of the comments that GFOA provides. Objective B looks at ensuring CERS policies and procedures around our financial reporting are adequate. We want to be able to provide essential information to assess accountability for the CER assets and pension management. Essential information is a phrase that the Governmental Accounting Standards Board uses on a regular basis in terms of what information needs to be included in governmental annual and interim financial reporting. So we want to make sure that we've applied their benchmarks and reporting standards to ours as well. We'll be watching for looking at our financial information to see if we're getting close to those actuarial goals that we put over in goal number 1. So we have a little bit of overlap between these two. The second section looks at some financial reporting metrics in our reports to look at how that helps us with our long-term trend analysis. I'm a big fan of what we call the economic reporting in the back of the financial statements that gives us some 10-year trend tables that are required by the Governmental Accounting Standards Board. I think that helps us to identify trends that are going in the right direction, maybe trends that are going in not so right direction. So the targets outline a number of issues that the committee thought would be important to monitor in that long-term trend analysis. Mike Lamb has helped us a lot with these particular areas and some of the recommendations that he has made for improving our interim financial reporting. And then the last objective was establishing an escalation policy for Mike's office to come to the committee requesting additional policy decisions for the committee. We've kind of left that to his discretion when he has issues that he needs our policy decision to strengthen his ability to develop a process that gets us where we need to be on a particular issue. And then, I'm sorry, we have one more in finance, and that is ensuring that all regulations related to participation of our employers and those employer duties are updated and codified. The legal department and our employee reporting and compliance section does a great job of working on regulations and keeping those updated. I'm not exactly sure how the new proposal in the General Assembly will affect our regulatory process. We might have to come back and revisit this particular one after we see what that final statute says on how those regulations will be addressed by the General Assembly. But we had a couple of areas here that we wanted to be able to work with both ERSI and our legal team to make sure we keep those regulations up to date and communicated to our employers. Are there any questions on the in finance goals, objectives, measures, targets?
I thought that one was really well spelled out, Betty.
Okay. The last section are the administrative functions. The Personnel Committee developed their own strategic plan and approved that in January of 2024. And I did the rest of this particular section back in 2022, 2023, when I was chair for the board, to try to outline some areas that I thought were important from an administrative function for the board to support our committee structure. So we have the Personnel Committee looked at adopting the CEO performance plan, which was on the agenda earlier today, an evaluation process for the CEO, and a measure to recruit trustees for elected and appointed positions. And Mr. Cheatham, I think you were talking to me about some suggestions for maybe adding some content and perspective to this particular measure.
Based on our trustee election process this time around, and the significant drop off in participation, I think one of the focuses we need to look at 4 years from now, is how to go about increasing that participation. So I just like to put that one on the radar screen, Betty.
I think one way to do that is to add a measure of
You there, Betty? Did we lose you?
No, I'm typing.
Okay.
So we could add a measure number 4 to evaluate the results of periodic trustee elections. To ensure that members are participating in elections. And did you have a target in mind, Mr. Cheatham?
Well, I think Kristen will be able to give us a little detail here in a minute, but based on the numbers that we've seen, we dropped from about, I think it was a 9% participation rate down to just over a 6% participation rate. If that's the case, I think our goal ought to at least to get back up to 10 or 12% participation. That would be my hope anyway.
All right, so I've added the phrase here that member participation rates should increase to 10% or higher.
Looks good.
Everybody like that addition? All right, some of these other objectives are things that we have been doing already on an ongoing basis, periodic articles and association newsletters, We've had quite a bit of discussion about webinars to expand our educational efforts, not only for trustees, but for our membership, to highlight some key retirement management issues for our members. I think our communications department at KPPA is working on some of those efforts. And then we regularly appear in front of the Public Pension Oversight Board to answer their questions and provide information that they request and need for their analysis. Trustee education is an important piece. We have a statutory mandate to complete each trustee has to complete 12 hours per year. There's been a recommendation to get those years consistent so that everybody's doing it on a calendar year basis. I had suggested that the board should provide in-person training of 6 hours and that would allow trustees the ability to go find 6 additional hours that suit their interests and fiduciary needs. So we added in our bylaws training sessions in January, July, and October, so that we reserve a day in each one of those months to provide a 2-hour in-person training session. I think I saw some other material in today's board packet for a trustee retreat later this year. And then we've added some discussion on risk management and also looking at our bylaws on a regular basis to update those as we need to do that, to keep our bylaws responsive to how it is we need to operate in that process. Any suggestions in the administrative section?
I think we're good, Betty.
And with that, Mr. Chairman, I'm ready to offer this strategic plan to the board to approve in its final form.
Okay. Anybody have any questions or additional suggestions for Betty? If not, I'll entertain a motion to accept the strategic plan as edited.
So moved.
Got a motion by, I'm sorry, I heard a second from somebody.
Dr. Carver.
Carver.
Dr. Carver, thank you. Okay. Any other questions, discussion? All in favor signify by saying aye.
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 Ayes have it. Thank you, Betty. I appreciate the hard work on this. I know it's been a labor of love for you.
Some days, yes. I'll hand the reins back to you, Mr. Chair.
All right. This time, I want to go to the Joint Retiree Health Plan Committee. Jerry, I believe that would be you, sir.
That would be me. No, let's see here. All right, let's see here. We had our meeting on February 13th. There was no action items to be brought before the board. Connie, you want to take it from there?
Yes, sir. I can take it from here. Okay. We met on the 13th, as Mr. Powell said, I believe, of February, and we discussed and went over the results of several reports as we do yearly at this time, and looking at the member satisfaction, the call center notice, just an FYI, and then some implementation review that Humana shared, as well as some value-added services. I wanted to point out that their satisfaction survey is pretty much the same as it has been, maybe just a little bit more. Plan usage and satisfaction had went up, I believe, a little, 92%. And then there was around, it's very close to the same as the previous year. And this includes, some stats around people that recommend it to Humana, to their family and friends, how many used their plans within the last 3 months, 86%. And then members that reported high scores of 7 or higher, looks like every 10 members, and there's around 4,000 people enrolled in these plans. Well, not these plans, I'm sorry, 60,000 in all of the Humana plans. So going on to just looking at their customer care experiences, um, the members again were lower in 24 and 2025 open enrollment season than they were in, well, just in 2022. So that tells me there weren't as many issues or questions or concerns about the process. Um, it remained, the resolution of any inquiries remained high at 79%. And I wanted to point out the net promoter score has gone up a little to 74.68. Anything above 50 is considered excellent in the industry. Um, any questions about those so far? If not, I kind of want to go over let Humana maybe go over the implementation. Tracy or Larry, someone, do you want to go over that part about the implementation review?
Sure, Connie, it's Tracy. I'd be more than happy to do that. So in 2025, we had a few errors along the way this year, unfortunately, that we were able to correct. But for the members on the Humana HM or PPO plans, we did have about 7,000 members who were moved to a different plan, and there was some confusion over their enrollment. That was all fixed prior to the effective date, but some members were confused. But we coordinated with KPPA staff and made sure that messaging around that was very clear so that we alleviated any anxiety or concerns for your members. And then you may also recall for 2025, January 1st, 2025, we did move the medical only and mirror plan. So there's about a little less than 4,000 members enrolled on these plans. These are ASO funded commercial type plans for your members who do not have Part B or may have some other reason why they can't be on a Medicare Advantage plan. So we did transition members to Personify Health as Humana had exited the commercial Medicare or commercial business. So we had worked previous to the implementation to get everything set up and arranged. But there were a few hiccups along the way. ID cards did go out late. There was some confusion as members were calling Humana versus Personify Health. So again, we coordinated as quickly as possible with the KPPA team and the Personify Health team to make sure that our messaging was in place. We made outbound calls to members to clarify those benefits. So I think we've recovered generally from that. I think we're still, obviously it's a change for your memberships. People don't always recognize Personify Health. But we're working with KPPA and the team at Personify to make sure that we're assisting members appropriately and as quickly as possible.
Thank you, Tracy.
Sure.
Humana reported the Medicare bid process, or they call it a CMS call letter in the industry, and that has been released. And the final notice and they release it early so everyone can make comments and questions, and they may change something. Possibly. So the final notice will be on April the 7th. There are still some things that may or may not impact our drug benefit going forward in 2026. Those details will be provided a little in the May meeting for the Joint Retiree Health Plan Committee meeting after that April notice is received, so that we don't misinterpret or misinform you about anything like that. From what the Medicare is proposing for 2026. And Humana did present an overview of their value-added items and services. Just a reminder, they have, even though we have dental built into the Medicare Advantage plans, there is still a discount for those who aren't on the Medicare Advantage plan. They can save up to a percentage based on just the Humana ID card. iMed has discounts for them. True Hearing has quite a bit of discounts, it looks like. Life Alert, Mom's Meals. There is a drug discount program, a discount for travel insurance, and a discount for pet telehealth are two new things for this year. I guess, those are things. Travel insurance is something I think is a very good offering because it's just something that people don't realize when they're on Medicare Advantage plans or Medicare period. Medicare doesn't cover much of anything outside the United States of America. So this is something that I would recommend anyone on Medicare consider. And actually, Medicare has that on their website under the Medicare.gov where they advise beneficiaries about things. They say that very thing. You might want to consider getting some travel insurance just in case, you're going on a short trip, things like that. You don't know what's going to happen. And we do have a small, and I call it small because there's around $5,000 benefit. That's not going to do a lot for an out-of-country admission or any kind of procedure or surgery, and that's all that we would be allowed to consider, and that's a Medicare as well. They have a small. So open enrollment was pretty smooth. I don't think we had a lot of increased calls. We did see a few more visitors, a few more virtual appointments, and people are still opening the emails and reaching out to us with questions, and that process seems to be going very well. And we have participated in the open enrollment on-site meetings for the non-Medicare eligible retirees and the Medicare eligible retirees. Do you all have any questions about any of these stats? They're pretty much, I think, pretty standard. There's nothing unexpected at this point that I believe. And if you don't, I'd like to thank Mr. Powell for being on the Retiree Health Plan Committee for so long and serving as chair. And I also would like to thank him for his service on the Kentucky Group Health Insurance Board that oversees the Kentucky Employees Health Plans for the state employees and non-Medicare eligible retirees. That was a commitment he made to attend those monthly, represent the retirees, and he actually dug into the benefit and has done a wonderful job, or an excellent job, let me just say that, of doing that for the retirees and keeping up with the stats and learning a whole new set of benefits that are not Medicare.
And a whole new language.
Oh, new language, sir. So yes, I wanted to say that was a large commitment, and I appreciate you continuing with it.
Thank you so much.
You're welcome.
It means a lot. And I think I want to thank Connie, the entire staff of the Retiree Health Plan, Humana, because I think our crowning moment is our funding level. Because the Retiree Health Plan in the last 2 years is actually funded over 100% for most of the plans. And that has made life a little better for some of the retirees that fall under particularly like the Tier 2A or Tier 2B and the 3s. So they get a little better benefit because of that. So again, thank you to all the retiree healthcare staff and all of our people with Humana.
Mr. Powell, I'll just thank you as well. It's been a pleasure working with you, and I wish you all the best in your retirement.
Yep.
Thank you, ma'am. And that concludes our Retiree Health Plan Committee.
Thank you, Jerry, and I'll certainly add my gratitude because this is an area that doesn't get as much focus as the pension side sometimes, but it's probably more important. Particularly with our older retirees that require quality health care. So again, we still have your phone number. With that, I'm going to move on to the next item on the agenda, which is the CERS election update. Ms. Coffey, you ready to enlighten us?
I'm ready. Good afternoon, everyone. So the election closed on March 1st, 11:59 p.m. March 1st. As of yesterday, we have 6,791 votes, so that's about 41 more than what's in this report because some paper ballots have come in that have been scanned by the vendor. They'll continue to collect those until around March 14th, and then on March 15th, they will send the election results to the chair and the CEO. As has been mentioned, right now the voter turnout and unless there's a whole lot of paper ballots that come in, this isn't going to change very much. For this election is at 2.38%. We've seen a decline in voting in the past several elections. This is the lowest that the turnout has been since I've been here. So anything, I think that was a good add to the strategic plan, anything that can be done to look at that and increase voting. If there's any questions, I'm happy to answer them. I cannot answer why the voter turnout is lower. I wish I could. But any other questions that I can answer, I'm happy to take.
I'd like to comment. I know that, being on the board 8 years, that we've tried multiple different avenues to increase that, thanks to the staff there, the audit committee, the KPPA audit, and this is really important for people, for our membership. I just don't understand why we can't get more interest. It's not through the lack of trying.
I agree with you, Jerry. Okay. Nobody has any other questions for Kristen? We'll move on to the CEO quarterly update.
Thank you, Mr. Chair. The report is in board book. I'll answer any question about anything there. There's only one call out I wanted to make, and that is in regard to the election. There was an issue that happened with the election. Kristen and everyone involved were very adept at getting us through it. We were able to rectify it so that we had a smooth election, but it highlighted that there was a bit of an issue with the procurement process with that. And so I wanted to put before this board that I believe it's important that when there is a significant procurement issue that involves CERS, that the CERS CEO should be a technical advisor there. I understand that technically I'm not an employee of the state. I can't be a voting member in procurement under 45A, but I can, I believe, be a technical advisor, because part of what I saw through that process was that there might be some ways to bring some efficiencies to that process that would be broad-based, but unless you're involved in it, it might be difficult to do. So that's, Mr. Chair, the only call out I have from the report.
Okay. I think that's certainly a valid thing for us to look into and make sure that we can make happen if it's a CERS, primarily a CERS or a significant CERS commitment funding-wise. We certainly need to have a seat at the table and understand what's going on and how it affects everybody. So I think that's something we need to look into and move forward with. I think Ryan's already committed to looking at that and seeing the most efficient way to do that. So I appreciate that very much. With that, we'll go on to Ryan, the KPPA quarterly update.
Sure. Following it, I know we have a heavy agenda, so I'm going to skip just to the last item. I think it's worth, going to try to make this part of my report just a kudos. A lot of times we're moving so fast, and just wanted to highlight. So I would say we could probably put benefits on this every single meeting. I have people that go out of their way to talk about how great that meeting was. Now, they're talking about retirement, Jerry, but they give really positive feedback. So just a couple of kudos. On the legal side, many of you got calls from Michael related to him working on the settlements, the whole team, CEOs, myself, days, nights, weekends during the Super Bowl. There was information there. Eric, I knew you were in there too, moving it forward. So while we still have a couple more steps, I recognize that. Moving to HR, the HR team and many throughout the organization exceeded our goal. KECC, some information in here. I think that's great. I've been a big fan of it before joining here, big fan of it while we're here. And it's team building, with that philanthropic goal throughout the state. I think it's really good. Investments accounting, I think there's been a lot of information. Carrie Bass has moved the project forward, got some exciting things coming on policy, but wanted to talk about that. Betty did a good job of talking about some of the awards that we got in the ACFRs. Very happy that Chris walked in my office today, the SAFR, in print, gave my first one out at a legislative meeting right before walking in here. So it's an exciting document. I've enjoyed this report prior, so kudos to the communications teams, and the whole organization really works on that as well. And then just to the boards being adaptable, Sherry, team, IT, on being able to do full remote. That was, some may have not even noticed that, but we had building closures and we're able to move forward the work, very important work of the boards throughout the agency. So just wanted to take a minute and hope to do this in the future. Kudos.
Thank you, Ron. We appreciate it, and I'll certainly agree with you. Your staff has done a remarkable job, particularly over the last 3 or 4 months with holidays, Super Bowls, and everything else to keep the ball moving down the field. So we appreciate that very much. All right, with that, I think at this time we need to move into closed session. Eric, you want to read it? You need to read that first or vote first?
I think you need to vote first.
I'll take a motion to move into closed session to discuss pending and possible legal issues.
I'll make that motion.
A motion by Jerry, second by,
I'll second.
second by Betty, I think it was. All in favor signify by saying aye.
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 Opposed?
Aye.
All opposed? Ayes have it. Eric, if you read our policy or legal statement here.
Motion being made in open session to move into closed session for the purpose of discussing litigation.
Okay. With that, Sean, if you will take us off